In my last video, I told you I found something. Today I'm showing you what it is. One trade per year, buy a single SPY LEAPS call option in January, sell it 12 months later, repeat. No day trading, no chart patterns, no weekly adjustments, just one trade. I tested every possible version of this across 67 years of S&P 500 data, going all the way back to 1957. Every crash, every bear market, every interest rate environment, and the data showed something I did not expect. More leverage does not always mean more money. There is a point where adding more leaps to your portfolio actually gives you a worse outcome, and the best answer was not the most aggressive one. Let me explain exactly what this trade looks like. Every January, I buy an at-the-money SPY LEAPS call option with about 2.5 years until expiration. At the money means the strike price equals wherever SPY is trading right now. If SPY is at $580, I buy the $580 call. 12 months later, that contract still has about 1.5 years time left on it. I sell it, I take the gain or the loss, and I buy a new fresh contract for the new year. The rest of my portfolio stays in SPY, regular index fund. The LEAPS contract is a small slice sitting alongside it. The question is how big that slice should be. 10%? 20%? What about 50-50? I tested all of them. One thing before we get into the numbers. This simulation starts with $100,000 and adds nothing. No contributions, no dollar cost averaging. In real life, you're adding money every paycheck, which helps a lot during the bad years. Now, LEAPS on SPY haven't been around since 1957. They started trading in the mid-2000s, so for the earlier decades, I reconstructed what these contracts would have looked like using a standard option pricing model and real historical data. Using S&P 500 prices, actual interest rates, actual dividend yields. Then I validated that model against the real option prices from 2019 to 2024 and confirmed it's conservative. The model underestimates real-world numbers, so the numbers I'm about to show you are the floor, not the ceiling. Let's start with the baseline, 100% SPY, buy and hold, dividends reinvested, $100,000 in January 1958, left untouched for 67 years. $80.3 million, 10.5% annualized. That's the benchmark. Now let's add a LEAPS overlay. Start small, 90% SPY, 10% LEAPS. $126.5 million, putting just 10% into a single LEAPS contract turned $80 million into $126 million. 0.75% per year doesn't sound like much, but compounding makes it enormous. Now watch what happens as we go higher. As you move from 90-10 to 80-20, the edge doubles. 80-20 to 70-30, you pick up another 0.25%. 70-30 to 60-40, barely anything, and then 50-50. 50-50 makes less money than 60-40. Not less per unit of risk, less money, period. You took more risk and got $25 million less for it. The returns peak and then they decline. Now, some of you are looking at that 60-40 and thinking that's the answer. Highest compound annual growth rate. So just do that. Let me show you why that thinking will get you in trouble. At 60-40, your worst single year is a 55% loss. At 50-50, 60%. But the real danger isn't one bad year. It's when the bad years stack up. At 50-50, the portfolio dropped 84% from its peak to its bottom across the dot-com crash. For every dollar you had at the top, you're looking at 16 cents at the bottom. Now, I don't care how long your time horizon is. Watching your portfolio drop 84% and not selling is something almost nobody can do. And if you sell at the bottom, you don't get the recovery. The recovery is where all the money gets made back. 80-20 captures most of the available edge before the drawdown started getting ugly fast. The best strategy in the world is useless if you abandon it at the bottom. The 67-year number hides a lot of variation. This strategy did not perform the same in every environment. Let me break it down decade by decade. 7 decades, 5 of them the overlay added real value. The 1960s added 3.6% per year. The 1990s, 3.5%. The 2018 to 2024 stretch added over 5% per year. But 2 decades, it hurt, and I need to explain why because it matters for what you do with this information. The 1968 to 1977 decade, stagflation. The S&P 500 barely moved for 10 years. SPY averaged about 3.2% per year. 80-20 overlay went slightly negative. There's a reason it dragged, and it's something called cost of carry. Cost of carry is simple. Take the interest rate, subtract the dividend yield on SPY, That number tells you how favorable the environment is for leaps. When carry is low, the overlay performs best. When carry is high, the edge shrinks or turns negative. In 2020, interest rates were 1.8%. Dividend yield was 1.7%. Carry was basically zero, and that's the sweet spot. In 1975, rates were 7.8%. Dividends were 4.8%. Carry was 3%. That's where the overlay starts to work against you. The 1970s averaged 3.5% carry. That's part of why the overlay struggled that decade. But even in high carry rate environments, there were years where SPY returned 30% and the LEAPS contract crushed it. Carry affects the average edge across the decade. It does not predict any individual year. That's why you set your allocation and you leave it alone. The 67-year number already included the high carry decades and the low carry decades. It accounts for all of it. Now, the other painful decade, 1998 to 2007. Dot-com crash, then the financial crisis starting, 2 massive crashes in 1 decade. Only 5 out of 10 LEAPS trades were profitable. The overlay lost almost 2% per year versus SPY. That wasn't about carry, that was about getting hit by 2 back-to-back bear markets where the LEAPS contracts got crushed 3 years in a row. But look what happens next. After the 1970s dragged, the 1980s added 1% per year. After the 2000s dragged, the 2010s added almost 3% per year. And then 2018 to 2024 added 5% per year. The overlay is self-correcting. You keep showing up every January with fresh contracts. The previous year's loss doesn't affect the next year's opportunity. Over 67 years, the LEAPS trade was profitable in 44 out of 67 years. That's a 66% win rate. Roughly 2 out of every 3 years, the contract makes money. And when it wins, the wins are bigger because of the leverage. Now, I need to be straight with you about the modern era because this is where recency bias lives. From 2013 to 2024, the 80-20 overlay returned over 20% annualized. That's incredible. It's also the best 12-year stretch in history for this strategy, driven by near zero carry rates. The honest CAGR across every rate environment, every crash, every boom is 11.77%, not 20. 11.77. That extra 1.28% per year over SPY is real and it's meaningful when it compounds, but it is not a cheat code. Right now, in 2025, with the 10-year around 4.5% and SPY yielding about 1.3%, carry is roughly 3.2%. That's moderate, bordering on high. The overlay still works here. The 67-year data covers plenty of periods just like this, but it's not the low carry rate paradise of the last decades, and you should not plan around 20% returns. Let me zoom in on the worst stretches because this is where you find out whether a strategy actually works or whether it just looked good in a bull market. 1973 to 1974, stagflation. SPY drops 37%. The 80-20 overlay drops 54%. At 50-50, you're down 74%. 2000 to 2002, dot-com crash. 3 consecutive losing years for the LEAPS contract. Each one brutal. At 80-20, the portfolio drops 56%. At 50-50, 77%. 2008, the financial crisis. The LEAPS contract lost 89% of its value in a single year. At 80-20, you're down 44%. At 50-50, you're down 60%. I'm showing you these numbers on purpose. If you're going to run this strategy, you need to know what it looks like when things go wrong, before you're in the middle of it, not during. But here's the other side. After 1974, the 1975 contract returned 109%. After the dot-com bottom, 2003 returned 64%. After the financial crisis, 2009 returned 79%. Every single time, you close the losing position, you buy a fresh contract at the lower price, and when the market snaps back, that new contract captures all of it. That's the structural advantage. The wins come right after the losses, and if you can stay in the seat through the turbulence, you participate fully in recovery. Now those are individual crashes, 2 to 3 years of pain. Let me show you what happens over a full decade because that's the real test. The lost decade, 2000 to 2009, SPY returned basically nothing, negative 0.9% per year. The 80-20 overlay made it worse, negative 5.2% per year. For a full decade, 20% of your money was working against you. And look at 50-50 in the same decade. Negative 13.2% per year. That portfolio lost over 75% of its value during a decade where SPY only lost 9%. Now, the stagflation era, 1968 through 1982. 15 years, SPY averaged 6.5% per year. Not great, but positive. The 80-20 overlay averaged 4.3%. It still grew your money, just slower than SPY. 50-50, negative, over 15 years. While SPY compounded at 6.5%, half your money being in LEAPS dragged the total return below zero. This is the argument that should make everyone think twice about going above 80-20. It's not about one bad year, it's about what happens when the bad years stack up. At 80-20, even the worst 15-year stretch in modern market history still made money. At 50-50, you went backwards for 15 years. That is the difference between a strategy you can survive and a strategy that breaks you. So here's where I land on this. I choose 80-20 for my retirement accounts. I have 14 years until retirement, consistent income, and I'm still contributing every paycheck. If I see a 44% drawdown in the worst year, it's going to be painful, but I'm not going to touch the money. I've been through market crashes before. I know what it feels like, and I know I can sit through it. Could I go 70-30 and capture a little bit more? The data supports it, but the extra 0.29% per year is not worth the jump from negative 44% to negative 49% in the worst year. Not for me. I'm not telling you what to do. I'm just showing you every allocation from 90-10 to 50-50 across every market environment in the last 67 years. Where you land on that spectrum depends on your time horizon, your income, your ability to keep contributing, and honestly, your ability to watch red numbers without touching anything. The data is here. You make the call. For me, 80-20 is the point where the extra return still feels worth the extra risk. Everything I showed you today used an at-the-money strike as the baseline, but the strike you choose changes these numbers, in some cases for the better. I tested every strike from 30% in the money to 20% out of the money across all 67 years, and where you placed the strike changed everything. Your allocation is only half of the decision. In my next video, I'll show you exactly what happens when you move the strike and why most option traders would pick the wrong one. The real edge in investing is not knowing more than everyone else. It's having a system you can keep running when it gets uncomfortable. Where would you land on the allocation spectrum? Would you take the smoother ride at 90-10 or push for that extra edge at 80-20? Drop it in the comments. If this changed how you think about building wealth, hit the like button. If you want to follow a real portfolio from accumulation to retirement, subscribe. That's what this channel is. Stay disciplined, stay patient, and I'll see you on the next flight.